All right, let's be honest with ourselves for a second. If you've been riding the AI wave over the last couple of years, watching those green candles shoot toward the moon, it feels pretty great, doesn't it? You might even start thinking you finally found it, the holy grail of investing, where every decision you make is pure genius. But here's the uncomfortable question we have to ask. Is that success actually coming from your elite skills, or are you just getting lucky? Because here's the thing, the tide always turns, and when it does, are you absolutely sure you can survive the next one? In this final episode of our series on Howard Marks's book, The Most Important Thing, we are building what I call the survival shield. These are the three fundamental tools great investors use to stay alive in a chaotic market: value, risk, and defense. Let's dive in.
Whenever we see someone crushing the market, we usually give all the credit to their elite skill and insight. That is, we believe results equal skill. Imagine two investors. Investor A is a serious analyst, buried in spreadsheets, charts, and 10Ks. Investor B is, well, let's just say he's a random guy throwing darts at a list of tickers. After a while, both of their portfolios show a massive 70% return. So, which one is the genius? The answer might be neither of them. You see, investment outcomes are always a mix of skill plus luck. This means you can make a brilliant decision and get a terrible outcome because of bad luck, or make a totally reckless decision and end up with a great outcome because the wind happened to blow your way.
Marks reminds us about alternative history, which is a fancy way of saying we often ignore what didn't happen. A good outcome might just be that 1% lucky break coming true, while we completely ignore the 99% probability of a disaster that just happened to stay hidden this time. Think about Warren Buffett's famous coin flipping metaphor. Imagine if every person in America enters a coin flipping tournament. Everyone starts with $1 and flips a coin once a day. In each round, the winner collects all the coins from the loser and moves on to flip again the next day. So, on day 1, the winner has $2, then 4 on day 2, 8 on day 3, and so on. 20 days later, someone who's been right 20 times in a row has won $1 million. He might even write a book titled How I Turned $1 into $1 Million in 20 Days Working 30 Seconds a Morning and start selling tickets to seminars. Sounds familiar?
Are those guys professional coin flippers? Of course not. They are just the lucky ones left standing, which is the definition of survivor bias. We tend to obsess over that 1 in a million success story and completely overlook the vast majority of people who failed doing the exact same thing.
In the short run, a massive amount of success comes from just being in the right place at the right time. During a boom, the highest returns usually go to the people taking the most extreme risks. That doesn't make them the best investors, it just makes them the luckiest for now. Randomness contributes to investment records way more than most people want to admit. The lesson here? You can't judge a decision just by its outcome. True performance has to be evaluated over the long run, across entire market cycles, to see if someone can be right consistently. Being right for the wrong reason is actually a death sentence. It gives you the false confidence to do it again, but with even more money, right before your luck finally runs out. This brings us to our first shield. If we can't trust results alone to prove skill, what do great investors actually focus on? They focus on the most fundamental relationship in finance: price versus value. Now, some people believe in the efficient market hypothesis, the idea that the price of a stock always equals its value because all information is already baked in. But as we've seen in previous videos, that's not how the real world works. When the market is in euphoria, people bid prices up to the stratosphere, far beyond any reasonable value. On the flip side, during a crash, they dump everything and prices drop below the floor. Why does this happen? Because price is driven by two things: psychological influence and people confusing price with value. The most basic mistake you can make is confusing a good asset with a good investment. A great company is a good asset, but if you pay 1,000 times its earnings, it's a bad investment. Conversely, a bad asset, like a struggling company, can be a good investment if you buy it cheap enough. At the end of the day, success in investing comes down to one simple math problem: value minus price. But what is value anyway? Value investors focus on tangible assets and current cash flows. Basically, what is this worth today? Growth investors focus on the future. What will this be worth tomorrow? The problem with growth is uncertainty. Think of it like this. It's relatively easy to value a local newspaper stand that brings in a steady, predictable amount of cash every day. But predicting the future of a brand new AI startup in a fast-changing industry, that's incredibly hard. That's why Buffett loves boring businesses, investing in simple companies with consistent earnings and stable cash flows where there isn't a mountain of uncertainty. It makes his estimate of intrinsic value much more certain. Sounds pretty simple, right? But the difficulty in investing is that even if your math is right, you have to hold that conviction firmly. The price might keep dropping after you buy it, and you need the guts to stay the course even when you're staring at a temporary loss. But even if you get the value right and you can hold it firmly, you still have to deal with the biggest problem of all: risk. Investing is really just one thing: dealing with the future. And because none of us have a crystal ball, risk is inescapable. So, to stay in the game, we need to pick up our second shield: controlling risk. But first of all, what actually is risk? Wall Street likes to say that risk is volatility, those ups and downs on a chart. Howard Marks completely disagrees. He says real risk is the probability of a permanent loss of your money. Imagine a roller coaster versus a cliff. Volatility is like a roller coaster. It's a wild ride, but you end up back where you started. Permanent loss is the cliff. Once you go over, you aren't coming back. To drive this home, think of volatility like a bouncy trampoline. It can be fun or provide opportunity if you know how to land. Real risk, however, is like walking a tightrope over a pit of spikes. On the trampoline, you're just moving. On the tightrope, one wrong move ends the journey for good. Now, common wisdom says higher risk equals higher returns, but that's a dangerous oversimplification. In reality, higher risk does not guarantee you higher return. If it did, it wouldn't be risky. Riskier investments are simply those where the outcome is less certain and the range of possibilities is much wider. When priced fairly, they should offer higher expected returns to tempt you in, but they also come with the very real possibility of lower returns or even total loss. So what actually creates this risk of loss? It's usually not just weak fundamentals. You can make a great investment in a weak company if the price is low enough. Real risk comes from psychology that is too positive, leading to prices that are too high. Ironically, the dull and ignored stocks that everyone hates are often the ones that offer the highest returns with the lowest risk, precisely because all the optimism has been sucked out of the price.
The trickiest part is that risk rarely looks like risk. When investors are worried and prudent, they demand higher risk premiums and lower prices, and risky investments won't even be considered, which actually makes the market safer. But when worry is in short supply, money chases every questionable scheme, driving up asset prices until the system becomes precarious. The most dangerous myth in investing is the belief that risk is gone. Paradoxically, risk is highest exactly when people perceive it to be the lowest. When everyone thinks something is safe, they bid it up until it's enormously risky. When everyone thinks something is risky, they avoid it until the price is so low that it's actually not risky at all. Since risk is invisible during the good times, we have to treat it like building a house in an earthquake zone. You can't tell the difference between a good builder and a poor builder when the ground is still. The flaws only show up when the earthquake hits.
An investor's job is not to avoid all kinds of risk, but to intelligently bear risk for profit. But how do we do it? How can we control risk? Think about how life insurance companies stay in business. They know the risk. Everybody dies. But they don't just guess. They analyze the risk by sending in doctors to check out every applicant. They diversify that risk by covering people of all ages, jobs, and zip codes. And finally, they set their prices, their premiums, so they still come out ahead, even when the inevitable happens. So, just like those insurance pros, we can actually take charge of the risks in our own portfolios. First, cut back or even better, eliminate your leverage. Remember, a single wild swing in price can wipe you out of a leveraged position before you ever get a chance to see the recovery. Second, do the boring homework and make sure you know exactly what that asset is actually worth. Third, never ever skip the margin of safety. Fourth, diversify. Don't let one bad break sink your entire ship. And finally, stay humble. Admit that you don't have a crystal ball and always prepare for the worst-case scenario. When most people think about investing, they only ever think about one thing: maximizing their returns. They just want to score as many points as possible. But there is a completely different way to beat the market. That brings us to our third and final shield, the defensive strategy. Think of a soccer game. You can try to outscore the opponent by attacking constantly, or you can block every one of their shots and wait for that one perfect opportunity to score. Defensive investing is really about one thing: dodging the losers. You keep up in the good times, but you excel by losing much less than everyone else when things go south. Offensive strategy is about striving for return, using leverage, chasing hot stocks, and having a concentrated portfolio. Defensive strategy is about the avoidance of losers. It isn't just a mood, it means really doing your homework and demanding a generous margin for error before you ever hit the buy button. You can balance these two strategies depending on the market condition, but never forget Warren Buffett's 2 rules of investing. Rule number 1, don't lose money. Rule number 2, don't forget rule number 1.
To survive, we also have to understand the pitfalls that create losses in the first place. Marx breaks these errors down into 2 categories: intellectual, where your information or analysis is just wrong, and psychological. We've talked about these psychological forces before, things like greed, fear, and just blindly following the herd. So how do you actually avoid these traps? It starts by watching the behavior of everyone else. When you see people acting like the party will never end, that's your signal to start heading for the exits. This means getting yourself mentally ready for a downturn before it actually hits. You might sell off your riskiest assets, cut back on your leverage, and start building up your cash reserves. In short, you're tilting your entire portfolio toward defense while everyone else is still busy dancing. We've covered a lot today, but in the end, it all comes back to these 3 shields. First, price beats quality. Remember, even the greatest company on earth is a bad investment if you pay the wrong price. Second, risk means permanent loss. Don't let the daily ups and downs rattle you. Keep your eyes on those spikes at the bottom, because that's where the real danger lives. And third, since luck is always in the room, you have to play defense. You'll never be able to control the dice, but you can absolutely control how you play the game. At the end of the day, investing isn't about being the smartest person in the room for a single season. It's about being the person who is still in the room and still in the game 20 years from now. If you can master these 3 shields, value, risk, and defense, you won't just be another investor, you'll be a true survivor. I want to leave you with one final thought. The next time you see a genius making millions on a massive speculative bet, don't just ask what they made, ask what they risked to get it. If this helped clarify how markets really work, stay tuned for our next deep dive. But wait, there's one more piece to the puzzle. How do you actually know when the market is getting too hot or too cold? In addition to the CAPE ratio and the Buffett indicator we discussed in previous episodes, in the next video, I'll show you one more tool we use to gauge the market temperature and spot bubbles before they burst. I'll see you there.